As accountants, we all have our regular clientele that need our services for auditing, financial statement preparation, and income tax filing, from a small business like a mom and pop restaurant to larger multi-million-dollar corporations. But what advice do you give to a new client that is starting a new business and they have to decide on an accounting method to use? They have two choices. It's the cash accounting method or the accrual accounting method. Each one differs on when they recognize their revenue and when to recognize their expenses. Today I will be going over the two types of accounting methods that are used. I will be doing a hypothetical situation and explain some of the problems that clients will encounter with each. Now, let's say that Nate wants to start a carpet cleaning business. He must choose between using the cash accounting method or the accrual accounting method to recognize revenues and expenses. Nate decides that he wants the method that would immediately show income or profit for his business. Now, according to the second edition of Intermediate Accounting, Reporting and Analysis by James Jones, cash accounting method recognizes revenues when the money is actually received, and the expenses are recorded when the business actually pays out the money to their vendors. In Nate's situation, say he goes out and he cleans the carpets for 5 businesses. He will bill each customer separately, and he's thinking that he might have the revenue and income immediately, but that is not the case. He won't recognize revenue until he actually receives cash or a check in the mail and then deposit it into a banking account. If Nate's goal is to see revenue as soon as possible, this option isn't the best one for him or for his company. Now, according to the April 2015 Journal of Accounting, Auditing, and Finance, the accrual accounting method recognizes revenues and expenses when services are performed or when parts are ordered. With this method, you don't have to wait till you actually receive cash. For Nate and his new company, as soon as he goes out to a business, cleans their carpet, and hands them the bill, he can immediately recognize that as revenue, even though he hasn't received cash in hand. And that goes for also if he orders parts for the business, he can immediately record it as an expense, even though they haven't actually paid out to the vendor yet. When Nate does decide which method to use, you have to understand the tax implications on how the business will be affected with the tax year. The problem with the cash method and the tax year is that the previous year's expenses cannot be claimed for the tax year's deductions. However, this is not the case with the accrual method. Another problem with the two methods is with the accrual method. With the accrual method, on paper, the business can show profits or recognition of revenues with like hundreds, thousands, or even millions. And that's all because they recognize the revenue when the services were performed and not when they actually receive cash. So on paper in the office, they would show they have this much money, but when in actuality they look at their bank statement with their bank, they could only have a few dollars, or they could have no money in there because they haven't actually received money from their clients yet. So a solution to that problem, if Nate and his company decide to go with the accrual method, is they would have one set of books for the office, and then they can also have a book that would, or print out a daily statement of their bank records, so they won't end up going short on money, and they'll actually know how much money they've had. Now, with the scenario I provided with Nate's cleaning services and the clear explanation of the two accounting methods, the cash and the accrual method, you and your clients can make better informed decisions on which accounting system should be used. Thank you.